You want to bet? You want to bet that Tesla stays under $600 by the end of this year? I'll take that bet. What kind of odds are you giving me? 4 to 1, 5 to 1, 10 to 1? What kind of odds? Welcome back, mindful investors. In the last video, I talked about the naked call option strategy and how most investors shouldn't touch it unless they know exactly what's involved, because the losses can be unlimited. For my Tesla less than 600 end of the year bet, there are two main outcomes there. Either is greater than 600 or less than 600 by the end of the year. We'll take a quick look as to how much we're risking and how much the reward is for this naked call options play. Number one, if Tesla is less than 600 at the end of the year, EOY, then what happens? Then we collect the premiums. We collect 100% of premiums, whatever it may be. Let's say it's $1,000. And then number two, Tesla gets greater than 600 at the end of the year. Then what happens? Then we'll take in some losses. To calculate how much losses, it depends on the stock price at that time. We'll let that be X. X is the stock price at the end of the year. Exactly how much will we be losing? It'll be X minus 600 times 100 shares per contract. So for instance, if Tesla is at $700, then it'll be 700 minus 600 times 100 equals $10,000. If it's at $1,000, minus 600 times 100 equals 40K. And why do I say the losses can be unlimited? Because it can be. Let's say if Tesla actually takes up to the moon. So the moon means infinity. So infinity minus 600 times 100 will still be infinity. So your losses will be infinite. In this video, I'm going to talk about how to mitigate this and limit the risk, so you know exactly how much you're risking to win how much. So the technical name for this strategy is called the bear call spread. I know what each of these words mean, but together, they don't make any sense. Actually, most terminology in the options game don't make any sense to me. What is call? What is put? Why don't we just call it bullish or bearish? Or up or down? What is calls and puts? But anyways, let's look at bear call spread. So bear call spread. All right. So bear, it means that your outlook is downwards. You're bearish on the stock. So generally your outlook is looking downwards. The call here, it just means that you're dealing with call contracts. Number one is to sell a call, and that's what we've done before with a naked call option. But what we have here is an extra contract as long a call. So long just means buying, short just means selling. So we're selling a call contract and buying a long contract. So without knowing further context, this kind of seems like it cancels itself out. So what's the point of all this? We'll explain it shortly. And then the last point is a spread. Spread is between these two, and you need the spread to calculate your upside and your downsides. So your upside, how to calculate it, and your downside. So the upside is just a differential of your premiums. And your downside is a differential of the strike prices. And we'll go through it in our example. So all this kind of clarifies the strategy, but we'll go through my example to dig a little bit further. So here's my example. I sold the Tesla call for December 18th at $600. So this itself was a naked call. At the time when I sold it, it was at $18.80. I had 5 contracts of them. As you can see here, my cost basis was 9.4K. And then right now the market value is minus 19.6K. And so I'm down 10K in the position. But wait, so my short call was down $10,000. But there's two parts of this equation. I still have my long call as my insurance. So let's take a look at my long call right here. All right, so here's my long call option. I bought the long call for Tesla at $620. And notice the expiration date is identical, December 18th, 2020. So this was my insurance ultimately. I have 5 long contracts and that's identical to my short contracts of 5. The average price of $16.40. My cost basis for the 5 contracts was 8.2K. And then the market value right now is 15.2K. So I have a gain of 7K for these contracts. So for my short call position, I was down 10K. But then I was up 7K for the long call options. So by delta, we're down 3K. And this long call kind of saved me $7,000 because without it, I would be down 10K currently. Now we'll calculate exactly what the maximum upside and downsides are. Max upside, it would be my differential of my premiums. I sold the calls at $18.80 and then I bought the calls at $16.40. So the differential is 2.4. Multiplied by 100 shares per contract is $240. And then my max downside is the differential of the strike prices. So the differential of the strike prices were 620 minus 600 equals 20 times 100 equals 2K. To answer the question at the beginning of the video, this is the exact odds I'm getting. So 2,000 divided by 240, that's approximately 8 to 1 odds. So I was willing to take this bet at 8 to 1 odds, which means I'm placing $8 to win that $1. And like anything in the stock market, there is a buyer and a seller. So I was a seller selling this odds to someone, 8 to 1, and someone on the other end was willing to play, paying $1 to win that $8. So this long call portion, I call it as insurance because ultimately you need to pay the premiums to protect your naked call. And how much are you willing to pay depends on how much are you willing to risk. So in my case, I was willing to risk $2,000, this differential. And I had to pay this $16.4 for it. But what if I didn't want to pay that much insurance? So let's say if I only wanted to pay the $10 for the insurance, then this strike price would have to go up, possibly to $650. Which means that our ultimate downside would be $5,000. $650 minus 600 times 100 equals $5,000. And then on the other side, if we're only to risk very, very little, let's say our insurance was at $605. So you're just risking 605 minus 600 times 100 equals $500. You're risking $500. It could be $18.30 for instance. So your max upside would be 18.8 minus 18.3 times 100 equals $50. So you're risking $500 to win this $50 and so forth. So the general rule here is that if you're willing to risk more on the strike prices, which means that you're willing to lose more money, then this differential is bigger, which means your upside is also more. On the contrary, if you're risking less, then your gains would be less as well. There's a lesson here in my bear call spread. I placed my ceiling back here mid-October. So right around this area, the premiums were 18.8. It was like up here somewhere. And then it tapered all the way down and down and down and down to about $2 just 2 weeks ago. $18 all the way down to $1. So my premiums was up 90%. And then they had the news that Tesla was entering the S&P, so that everyone was chasing. So this was the chasing period. And this is possibly the short squeeze phase, which means that there are a whole bunch of people with these naked calls that has to buy a lot of these shares, causing these gap ups. The lesson here is that if it's a really volatile stock like Tesla or any of the EVs, if you're up 80-90%, it may be a good time to just settle the contracts. Because this type of jump can happen to any one of them. They blow up the best news ever and then the short squeeze comes in. So that may be a lesson learned. I definitely wasn't paying too much attention to this. I still don't think they'll be over 600 by the end of the year. And there are two reasons for it. Number one, we discussed it in the last video. The fund managers tend to sell off at the end of the year to capitalize and show the gains on the portfolio so that they can sell the future clients next year. And then the second reason is that Tesla is entering the S&P 500 on December 21st. And since the announcement 2 weeks ago, everyone was buying in, saying that they're the real deal and they're the bulletproof EV stock. And whenever this type of thing happens, that all eyes are on them and all the investors are bullish on it, what other forces can still drive the stock up? I'm not saying that the stock will crash to like 200. It can hang around the 500 to 600 phase. It's okay to be stagnant. It's okay to taper off a little bit. And if it doesn't and continues to shoot up, I have a backup plan. I have a different lifeline that I'm going to talk about in the next video. Stay tuned. So what do you think about this bear call spread strategy? It kind of gives a peace of mind to know exactly how much you're risking and winning, right? Like and subscribe if you found any value in the video. Thanks for watching, take care, and I'll see you in the next one.